And let's take a look at the slides from chapter 5. Okay. And we're going to continue our discussion of inventory, which we actually started in chapter 4. We realized that if you purchase inventory, we learned on the exam, we had questions like this under the perpetual inventory system. We debit the inventory, we credit accounts payable, cash, whatever, right? And then what? As we sell that inventory, we debit the cost of goods sold and credit the inventory under perpetual inventory system, right? Well, think about it. You have hundreds, thousands, hundreds of thousands of items in inventory. It gets a little tough to keep track of the sale of each and every one of those things, particularly if you're selling tubes of toothpaste or something like that, right? So what we're going to learn is we are going to have something that we call cost flow assumptions. And what cost flow assumptions allow us to do is determine how we sold things. Did we sell our most recent purchase first, or did we sell a purchase that we had several months ago first? Okay, we use these cost flow assumptions, and the key ones that we're going to talk about are first in, first out, otherwise known as FIFO. We're going to talk about last in, first out, otherwise known as LIFO. So we're going to talk about those two inventory methods. We'll also talk about something called weighted average, which is a cost flow assumption, probably the easiest of those three. And then we'll talk a little bit about specific identification. Okay, with specific identification, you don't have to have a cost flow assumption. I got it. You don't have to have a cost flow assumption. You just assume that you don't assume anything. You just keep track of your items as you sell them. That is typically used for what? Large ticket items, right? Where it's going to be much easier for say, did we just sell that Mercedes? Yeah, we did. You probably use specific identification for that. Okay? Okay, so again, if we're talking about inventory, we are typically talking about manufacturing companies, right? Okay, not manufacturing companies, excuse me, merchandising company. Manufacturing company is what you're going to be really focusing on in 101B, where we're actually manufacturing the items. So we're going to have to start with raw materials. We'll go to work in progress. Then we'll have our finished goods. In 101A, we really start out with finished goods, and we don't really call them finished goods because we're probably purchasing them from the manufacturer and we're having them in inventory. So a manufacturing company might be Nike. A merchandise company, a retail company is going to be Nordstrom, let's say, right? And we're looking at the standpoint from Nordstrom. I heard on the news today Nordstrom hired something like 20,000 seasonal workers or something like that, right? And they said that that's down a little bit from last year. So when we're looking at employment numbers and we talk about, I always used to ask myself, why do I use Nordstrom all the time in my example? Probably because they're probably one of the giant, biggest retailers there is, right? Okay. Okay. Now we are going to look at two different accounting, really focus on one accounting system in this class, perpetual. Periodic, we talked about beginning inventory plus purchases gives you goods available for sale minus ending inventory gives you the cost of goods sold, and we have to actually count our ending inventory to know how many items we have left in the calculation of our cost of goods sold. We don't use that method in here. We use the perpetual, but remember I said it's sometimes helpful to remember that beginning inventory plus purchase equals goods available for sale minus ending inventory equals cost of goods sold, because what? It might be helpful if we ask you one of them dumb questions on the test where we make you work backwards to the beginning inventory or the purchases or something, right? Okay? Okay, good. So when we take a physical inventory, we are literally going to be looking at our inventory sheets and seeing that what? Seeing that everything actually is existing in our warehouse, whatever, right? Okay? If we're not going to, if we're going to use a perpetual inventory system, do we still need to count the inventory from time to time? Why? The record should tell us, hey, there's 50 laptops, right?
Sometimes they grow legs.
Sometimes they grow legs. People will steal from us if we don't take the inventory periodically, right? When you take inventory, how do you do that anyway? It's not usually a story I tell in my accounting class, but I usually tell in my auditing class. How do you take inventory? Like this, huh? You count the items and you compare it to what?
Previous count.
Well, for inventory, it's the records of items you have in inventory, right? So do you go any tables in here? It says one table. Oh, there it is. Is that how you do it? Huh? That's not how you take inventory. I was on an assignment once where we were counting inventory at the Senate restaurant. Okay, the Senate has its own restaurant. Okay, they can't eat with the commoners, right? And so what happens? GAO is the one that's supposed to audit the restaurant, and because one of the experiences you have to have in order to get your CPA license in the state of California is you need to actually have done certain audit procedures, and one of them is counting inventory. So it gets a little tough to get us those experiences. So they used to make sure that we got the opportunity to go and participate in that from time to time when you were ready to get that experience. So I go the year we're doing the Senate restaurant, and they give you this parka when you show up. And you say, it's the middle of October, or it's the end of September, why would I need a parka? And all of a sudden, off you go into a freezer to count the inventory. Okay, and when we get in there, those guys are sitting there from the inventory listing saying, how many chickens in here? And they go over and they count, Sarah, 23 chickens, okay? Next, how many pork butts? And they go and they count 43 pork butts over here. And I tell them, excuse me, guys, but you're not taking the inventory right, and I'm not shaking because I'm scared. Okay, you are supposed to go what? Ceiling to floor, wall to wall when you take inventory. You don't read off the sheet because there's a potential that there's something that what is not on the sheet that is actually sitting over there in the corner, a box of filet mignons, and if they realize, hey, the auditor never saw that we didn't count the filet mignons, Bob, he doesn't even know they're not on the inventory list, away they go, right? So there needs to be a detailed count of the inventory that's done, and under the auditing standards, they require that the auditor is present to watch to see those procedures. We watch those procedures, and we do that as a pre-test, and then we feed back to them any discrepancies we saw in the process. They sent out a memo, a GAO said, we ain't doing it right, we need to fix this and that, and then the next day you come back and you watch the inventory being taken correctly. So there needs to be careful inventory taking technique that is actually witnessed by auditors to make sure that that process is being done properly. Okay? All right, so just a little ethics note, I guess, here that they have, and that's my little story. Okay? All right, so we come over, and we have the issue of goods in transit. And if goods are being shipped in transit, we talked about this in chapter 5, didn't we? Okay? 4, I mean, right? In chapter 4. If this is chapter 5, if items are being what? Shipped, then we have to look at the shipping terms to determine if we should include that as part of our ending inventory or part of what? Part of the, well, no, part of our ending inventory or part of the, well, I'm assuming we're the buyer, so let me be more specific. Part of the buyer's ending inventory or part of the seller's ending inventory, right? Okay, the actual, I'm talking about the actual physical items, okay? So we look at the terms here, and if it's free on board what? Free on board shipping point, that means the buyer pays. The buyer paid this guy, right? And title transfers to the buyer as soon as they are picked up, right? So if the items are picked up on December 23rd, but they don't arrive until January 3rd, we still include those in the buyer's inventory at December 31st, even though they haven't been touched the items yet, right? Because we arranged for this person here to pick up these goods, okay? Now, if the buyer pays the freight, the cost of the freight, and I think that's where you were going with that, Sherry, and probably the more important point for accounting, the what? The cost of the freight charge is part of the cost of the inventory, isn't it? We add it to the cost of the inventory. And when we look at fixed assets in Chapter 8, we're going to see that any cost that you pay to get an asset to where you can use it productively in your business is part of the cost of that asset. Same thing with equipment, right? Inventory, the cost that we had to pay to get that inventory to our store so that we can sell it is what? part of the cost of that inventory, because Nordstrom knows that if you send them to the producer's warehouse, you're not willing as much to buy that pair of shoes as you are when you get to hear the piano player and you're drinking a latte while you buy that stuff. Does they still have the piano player at Nordstrom? They got rid of the piano? They shot the piano player? Sorry, there's an old thing that's shooting. Don't shoot me, I'm only a piano player. Yes, the cost of anything you got to pay to get that thing home to your place of business is part of the cost. If you pay the insurance on freight, if you pay the freight, if you pay a tariff charge, if you buy that computer, didn't we do this last time?
No.
And I'm not sure because
taxes,
all part of it. The tax that they make you pay for the disposal fee on the computer, that's part of the computer fee, right? That's part of what gets capitalized as part of the cost of the computer. Okay. I had a former student that took my class, and she learned a lot of things about the way accounting should be properly be done, and so she kept correcting people at work. Well, we're supposed to do it this way, we're supposed to do it that way because they're doing things wrong. And then she called me like, a couple weeks after she got this new job, and she was kind of pushing people around. Or maybe it was a couple months, maybe 6 months, I forget. She got fired because they were like, I think they got tired because I kept telling them which way to do things. And I think the other reason they fired her was because her bonuses were just getting ready to come due if she stayed like another week, and they fired her just before the bonuses kicked in. But she found another job like the next day. She was a very competent individual and a hard worker. She found the job the next day. I told her she's better off to not be there. Anyway, so what happens? You sit there and don't be a know-it-all, but you would include all of those items, right? Okay. Now what happens? You sit here, and if the seller pays the freight, then it is what? Then it is free on board destination, and what? Title does not transfer until the goods are actually received. So what happens? We wouldn't include those items in our inventory until January of the next year, right? The seller does not take a sale until we actually receive the goods. So that would be a sale in January, wouldn't it? And what? And the shipping charges now, the freight that is paid by the seller is now going to be a selling expense. It's part of our operating expenses, right? Okay, so we talked about that a little bit last time. Any question on that? No? Okay, good. So, goods in transit should be included in the inventory of the buyer when the terms are what? Free on board shipping point, right? That means that what? That means that the buyer paid the freight, and those costs are going to be included in with the inventory account, right? Okay, good. So just review of what we talked about last time. There's also something called consigned goods. So what happens here? Let's say after you get your bachelor's to transfer from Ohlone, and you go on to, the UC system, and then, I don't know, you get hired as a Rhodes Scholar, and all of a sudden, not hired, but you recruited to a university, Oxford or something, and you're in England, and you say, but true, spice of life, the true essence of life is in the Fremont Hills of Ohlone, right? So you go ahead and you write a book, the Fremont Hills of Ohlone, right? And you try to take that book to Barnes & Noble. And you say, Barnes & Noble, buy this book from me. It's going to be a bestseller, right? Barnes & Noble says, we don't think so. We're going to pass on this. You say, please, look, I'll leave the books here. And if somebody buys them, then you go ahead, you keep 2% of the sales price, and I'll take all the rest. If nobody buys them, nobody loses, I'll just take the books back from you, okay? End of the year comes, those goods are considered out on consignment. You are the consignor, and Barnes & Noble in that example is the consignee. Barnes & Noble would not include those books in their ending inventory. You, however, on your balance sheet would include those items in ending inventory, even though what? Even though they're sitting in Barnes & Noble store, right? If the books burn somehow, Who suffers the loss? You do, right? The consignor does, not the consignee. Okay? Okay, good. So let's take a look now at these different methods of accounting for inventory. This is going to be the major part of the discussion here tonight. We're going to talk about specific identification in which we really account for each item as we sell it. Now look, we're not talking about packs of gum here, right? We're talking about large ticket items like vehicles, right? Houses. They're going to show TV sets over here in a minute. I don't know that TV sets are big enough to use specific identification, but we'll humor them on that, right? And say TV sets. Okay? When we're dealing with what? When we're dealing with smaller items, smaller ticket items like toothpaste, we can use cost flow assumptions. Okay? Notice the bracket is only on these three: FIFO, LIFO, and weighted average. And we're going to talk about each one of those. Is going to be the major discussion here. Okay? Now, specific identification is very straightforward. As each item is sold, they go ahead and what? They take track of those items that is sold as cost of goods sold, item by item, and the items that aren't sold yet are still sitting in what? Ending inventory. Okay? So, in this example then, in this little slide here, forgot to get out my pen. 1 second. I have a feeling it's going to take me a second to find it, so rather than wait forever. And then he said yes. Sorry you missed that joke. Okay. All right. So anyway. Now what's not funny is that I closed my slideshow that I wanted. Now that's not funny. Somehow I closed the slideshow in that process. Not any of the ones that I'm not ready to present, just the one that I wanted to be here. So let me find that now. Okay, so slide 10, slide 9. Okay, all right, so the journal entry that I was trying to get to, that I wanted to put on this slide. Oh, does everything have to be a battle? Do we have to go through a battle for everything? Okay, all right, so I'm talking to the computer now. Okay. So what happens? You sit here, and the journal entry that you're going to make when they sell these things is going to be to debit what? What's the debit? Good. Debit to cost of goods sold. For what? 1,500? And credit what? Inventory 1,500. Right? Okay. And of course, sitting still up and ending inventory, and the assumption here is that we what? We would have had originally a balance of, what's 750 times plus 1,500 is what? 2,250. So we would have started with a balance of 2,250. Right? And then I guess when we credited it 1,500, this is inventory up here. When we credited the inventory for 1,500, we ended up with the 750. And that's for our inventory account, right? Okay? Okay, good. So that's all that's going on there. Now, that's specific identification. Each time you sell something, you debit the inventory, you credit the cost of goods sold, right? Okay? Now, you take a look, and we have these cost flow assumptions. And again, we're going to talk about LIFO, FIFO, weighted average here tonight. And you notice that FIFO is the most commonly used. The reason FIFO is used most of the time is that it is the easiest method to use, not from a standpoint of a student trying to calculate it. I think weighted average is actually the easiest from a student standpoint, but from a standpoint of a company actually trying to keep track of your inventory, it's the easiest because you just do what? You just assume that your goods flow out in the manner that they probably do, which is what? I purchase an inventory item today, I purchase an inventory item the next day, I purchase another inventory item the day after that, and then when I sell them, I sell what? That one that I purchased on day 1 is the one I sell first, the one I purchased on day 2 is the one I sell second, the one I purchased on day 3 is the one I sell third, right? And I just go through and sell my items first in, first out. And that's really the way most inventory items flow. Why do most inventory items actually flow that way? First in, first out. Why does the company try to sell you the things that they purchased a while back first?
Expiration dates?
They know if we're talking about milk or dairy products, expiration date is a concern, right? Okay, what about Nordstrom selling you clothes?
What's the latest trend?
They don't want to get stuck with last year's styles, right? So what do? They go ahead and they sell you this summer stuff during the summer, right? And they're not going to sell you the fall stuff, right? Now, that's why when you go in and you say, do you have any more in the back? They always say, just what's out there, because they don't want to go in the back and find the stuff because they're not supposed to sell it to you yet, right? Okay, so most items actually flow that way, so it is pretty easy for us to keep track of our accounting system as the goods actually flow. That's how we account for their sale, right? If we use last in, first out, it is a cost flow assumption. The key word being what? Assumption. The goods may not actually flow that way. We're just going to pretend like they flow that way. And if that's the case, we're going to have what? One accounting system that's keeping track the way our goods are actually flowing so we can take a proper inventory, but another accounting system that is sort of this assumption way that they're flowing, right? And so we have to double up on our accounting. That gets more costly, so what happens? More companies use FIFO than LIFO. Now, if it's more cumbersome to use the LIFO than the FIFO, you ask yourself, then why would anybody ever use LIFO? We're going to learn that there are certain tax advantages to LIFO for some companies that make it worth it to them to go through the extra cost to keep track of this sort of fictional assumed flow of the goods, and so they choose to go ahead and do that because the tax purposes make it worth it. Okay? Weighted average is probably a little easier than LIFO, but there's not much benefit to it. It's not as easy as FIFO, and there's not much tax benefit to it, so only a few companies use the weighted average method compared to the other two. Then there's this other, and unfortunately, we're going to have to deal a little bit with this gross profit method because they decided to include that on your next midterm. I don't think that it's something that should be really bothered with in an introductory class to accounting, but I have to because it's on your test and I don't have control over what they're putting on the test. So we'll have to take a little short, quick look at that. Okay? But most of our time is going to be spent with what? FIFO, LIFO, weighted average. Okay? Okay, good. So let's go ahead and let's think about FIFO for a second, okay? And we say the cost of the earliest goods purchased go to cost of goods sold, and then the most recent items that the company has purchased are going to remain in ending inventory, okay? Now, what I'm going to do is go to a different software, okay? And I forgot to boot it up, but it's not a problem for me to get this. I want to go to a different software that I know has a better pad that I can write on. Okay, because I'm going to just give you a little example of FIFO, and you don't have to write this down. You can just watch, kind of like going to the movies. Do you take notes when you go to the movies? If you do, stop doing that, okay? And you're just going to watch and just get a feel for this, okay? So I just want to go ahead and get my pad here. Oh, no, wrong software. That's not the one I wanted. I want that one up there. Okay, I will. Okay. Okay, I want this pad. Okay, this is what I want. This pad is good for drawing, gives me a little more space. Okay, so what we're going to do is we're going to go ahead and do this little example. Okay, and so tell me if you've ever been in this store before. Have you ever been to Safeway? No? What are you, Lucky's guy? Okay. You know, I went to Safeway yesterday. They don't have any avocados. None. The whole place is wiped out of avocados. I said, what happened? They said, huh? Was Trump standing up there going, no avocados? We're going to build a wall, keep the avocados out. Oh, is that right? Okay. Okay. They didn't have any. I thought, man, he must have blocked and put that wall up sooner than when we were looking, right? Okay. All right. So what happens? We're sitting here and we got what? We got Safeway. Okay. And you go all the way to the back to Safeway and you see what? You see this, not the avocados. You see the milk fridge, don't you? All the way there in the back? Okay. Okay, good. Now, this right here. Does Safeway own some trucks? Okay, this is the truck, and the truck is delivering the milks, right? Okay, and so what happens? They take a delivery of the milks on 1031. This one's a little more stable, so I think I can write on this one without it jumping all over the place. 1031. Okay, and Safeway's paying, say, $4.75 for each one of those. Okay, and then what? They also had gotten some milks on what? On, say, 1015. And that's what? 450. Okay, and then what? And then they also got some milks on 10-1, and that's 425, right? For those Safeway paid. Now, here comes this person over here with their shopping cart. Who's this? Okay, well, that's not me. That's you, and you're pushing the shopping cart with your feet, apparently, because I wrote it too. Didn't give myself enough room. But there you are, and you're going to do what? You're going to reach in the milk fridge, right? And you're going to put into the cart these 10-15 ones for 425. 10 ones, I mean, for 425. The 10-1 ones, okay? Now, this is FIFO, okay? The assumption is that the purchaser is going to do what? They're going to purchase those things that the store bought a while back, aren't they? Okay? So sitting here in the cost of goods sold is what you put in your cart, right? Now, Safeway is going to charge you how much for them milks? Well, no, Safeway needs to make a profit, right? So they're going to charge you $5, and their cost is what? $4.25. That difference is, we call what? Gross profit or margin. That's $75. I don't mean margin like the butter. This is what? Gross profit. The milk doesn't become margin then. It's what? It's 75 cents is the gross profit, right? Okay. Now, what's over here? What's over here? Ending inventory, right? So what Safeway shows in ending inventory are those items that they did what? That they most recently purchased, didn't they? Now, sometimes students will say, well, John, when I go to Safeway, I don't grab the 10 ones. I grab all the way to the back, right? Okay? And so what happens? This is a cost flow assumption. I don't care if you go back there and beat up the truck driver, make him take you back and get the milk straight from the cow at that point. We're going to assume that you did what? That you grabbed the 425 ones, regardless of what the actual flow is. We assume what? FIFO. Now, it so happens that what? That most goods actually flow this way, don't they? Okay, and so that's why most companies just go ahead and use FIFO. Okay? Okay, good. So that's the FIFO method. That's the way we're going to keep track of these items. So let's go ahead, now that we understand FIFO from a visual standpoint, and I'm sort of debating in my head while I'm talking to you if I want to go to the in-class example now or if I want to wait till we talk visually about LIFO. Let's just do FIFO right now. Let's do the example, which means I have to now remember where I put the in-class example. Chapter... Who's that? Huh? Okay. Well, I just the only problem that I have is, I mean, we're all adults, but it's kind of like getting this FIFO stuff is a little bit FIFO, LIFO weighted average is a little bit tough, and it's like one of those kind of things like you leave the movie and then you come back and all of a sudden, the hero was started out as a man and now is a woman when you come back and you go, what happened? Oh, yeah, you missed it. Okay, I can't explain it to you now. Okay, I mean, it's one of them kind of things. Okay, so anyway, let's go ahead and let's take a look at this. And we have this example of this Buster's Corporation purchasing inventory in 3 separate batches as follows. Okay, so they go ahead and they give us this information, and I just want to get this so that it fits better on the screen. And I think if I do this and then I go page width after, okay, that should be good. Okay, good. So we come over and we're going to look at 3 different methods for this. They purchased their items, and they purchased this first one, batch 1, and they purchase what? They purchase batch 1, 4,000 of those at 425, right? Then they go ahead and they purchase this batch 2, 2,000 of those at 450. And then we go and batch 3, 3,000 at 475, right? Okay, good. So we go ahead and we have these purchases, and just to make sure we understand here, 4,000 units in total were sold, and I want you to cross this part out. This is not going to be relevant for our studies here, okay? Just cross that part out. And 4,000 units in total were sold, right? So you look at this, and what happens? They bought, huh? Oh, did I? Okay, good. So it's not there. Okay, good. So for the ones you have, I already took it out. Okay, good. So what happens? We sit here and what? We have these 9,000 units that we bought, don't we? Okay. And then what? Then we look and we see that there was a total of 9,000 units that were purchased. They started out with no inventory. They just started business. They purchased what? 9,000 units. So they had available what? 9,000. They sold 4,000, and now there's what? Oh, you need this thing. There's a 2-sided one. This is the one you want. Is it 2-sided? Yeah, it's just one. 2-sided one document. Right here, this gentleman. You got a 2-sided one? Oh, there's somebody else that doesn't have it? Okay, so we sold what? We sold 4,000 items, so we have how many left? 5,000. Okay, we have a total of 9,000. Okay, we have a total. Everyone got a two-sided one? Okay. Okay, so we've got a what? We've got 9,000. We sold 4,000, so there's how many left? 5,000 left, right? Okay, good. Now, let's go ahead and see how we'll account for, and where we're going to look at this is questions we'll ask you for the cost of goods sold and ending inventory under what? Under any of these three methods, weighted average, FIFO, and LIFO. We're going to use what? We're going to use FIFO first, right? Okay, since we just looked at that example. So let's just go ahead and let's look at FIFO, and let's jump down, and we want the cost of goods sold, don't we? So since we want the cost of goods sold, and since we bought what? Since we bought batch 1 first at those 425s, how many of those were there? 4,000. So under FIFO, we're going to assume that what? We sold all of those at 425, cost flow assumption, right? We sold all those 425 ones at 4,000. So we go ahead and we do what? We take to cost of goods sold coming back down for FIFO. Cost of goods sold for FIFO is going to be my what? My 4,000 units. Where in the world am I here? What did I do? Go all the way to year 2? Okay, so I have to come back up. FIFO is going to be what? All 4,000 at what? 425, so that's going to be $17,000 for my cost of goods sold, right? Pretty easy, right? I sold 4,000. I assume that I sell from that first batch first. That's those milks in the front. In fact, let's just do that. Let's label this with the dates. This was the 10-1 ones, wasn't it? These were the 10-1s. This was the what? 10-15, and this was the 10-31s, right? Okay, and so we assume that what? We sold these first, don't we? At 425. So when we do our cost of goods sold, it is simply 4,000 times the 425, cost of goods sold 17,000, right? Now we got to get ending inventory. Ending inventory has what? We bought 9, we sold 4, so there's still 5,000 left, isn't there? So when we cost out the 5,000, 2,000 are from batch 2. That's that 450 ones. Batch 2, how many did we buy? We bought 2,000 at 450. We extend those out. That's going to be at 9,000, isn't it? Okay, good. And then what? And then we need 5,000 units in ending inventory, so the remaining 3,000 are those only ones that are left, frankly, at this point. But they're the what? The batch 3 ones, the 3,000, right? The ones we bought on 1031, and those get costed at 475, don't they? So you go ahead and you do the math on that, and you are able to calculate your cost of goods sold and what? And your ending inventory, the 9,000 from batch 2 plus the 1450, right, from batch 3. Right? That's it. First in, first out. The way we cost them is what? For our cost of goods sold, it's the ones that we purchased a long time ago. For ending inventory, it's those more recent purchases, isn't it? Yep. Okay. Okay, good. Now you come over and let's talk about our buddy LIFO. I think I can leave this like this, right? That way we can get more easily back to the pad when I show you the pad. Okay? So let's just go ahead and let's take a look at this now. And for our last in, first out, we assume that the latest goods purchased are the first ones we sell you. So now we're going to sell you from the back, aren't we? That's at least the cost flow assumption. Okay, and what? The items that are in ending inventory are those items that we bought a long time ago, right? Now, again, you say, but most people grab the milk in the front. Doesn't matter. This is what? A cost flow assumption. I had people before say, but won't the milk spoil under LIFO? We're not talking about the actual flow of goods. We're talking about the cost flow assumption, right? Okay? And so what happens? That's considered last in, first out. And so let's just go back And let's look at the pad again. And I'm going to go ahead. I got room right here. LIFO can go right here. I'll put it in blue. See how much better the pen is on this software? I don't understand why Microsoft can't just make their pen work like this. What's the big deal? Okay. All right. So you come over. And this is an example of LIFO inventory. Now, what is this? I was having some gardening work done in my backyard, and I decided I wanted to put some rocks back there, some decorative rock instead of tan bark, because the tan bark withers away and then you got to have it replaced after a while. So I said, oh, I'll just put some rocks back there. So I asked these guys, okay, I want some rocks back here. They say, okay, that's fine, but you got to come with us to pick out the rocks. I'm like, no way, I don't want to go with you. You got to come with us to pick up the rocks. And I'm thinking, why? And I figured out, oh, I know probably what happened to them is they probably put a bunch of rocks in somebody's yard, and then the person went, oh, I hate those, take them out. And putting rocks back into the truck is probably a whole nother level of labor than what? Dumping them out, right? So now they learned the hard way. No, we're making you come with us, and you're going to point to the ones you want. So I reluctantly go with them. Piles of rocks like this sitting everywhere. Accountant head, I go, oh boy, actual LIFO inventory finally, right? Because what happens? When the delivery truck comes to deliver the rocks, now this is from the rock quarry, whatever, wherever they get these rocks, I don't know. Okay, that's a truck. Okay, and when the rocks guy comes to deliver, when the delivery from the quarry comes, what do? They dump the rocks on top of the pile, don't they? They don't knock the pile down and say, okay, let's get them on the bottom because these are the old ones, right? They sit there and they just dump them on top, right? So what happens? If the rock vendor here is selling these, then the 425 ones are on the bottom. The 450 ones are somewhere in the middle, aren't they? And the 475 ones are going to sit here where? At the very top, aren't they? Okay, just looking at straight from the standpoint of the deliveries. Then what? Then when my guys come and I come with them in the truck here to pick the rocks up to take back to my house, what? We don't say knock the pile down because we got to get them 425 ones. We do what? We go ahead and we just pull some rocks off the top, don't we? Now the rock guy is still selling us those for $5, aren't they? Okay, so what's the gross profit here for this guy? It's going to be 25 cents for this guy, gross profit on these. Okay, so last in, first out, what? The last delivery is the first thing that they sell us. Now again, this is a cost flow assumption. If Safeway wants to, they can use LIFO, but you're saying, but the milks will spoil. No, that's not. They're not down there at the 425. They may very well sell the 425 milks first, but their accounting system is going to allow them to account for that as though they sold what? The 475 milks first, and what? The 425 milks are still sitting down there in ending inventory, aren't they? Is this? And these guys, if they wanted to, they could do FIFO. That's correct. Based on what they want to do. They wake up in the morning and they go, oh, yeah, LIFO. Another person wakes up in the morning and they go, oh, yeah, FIFO. Okay, that's all they got to do. They pick one. They get there in a dartboard and they throw the dart. The dart hit LIFO, that's what we're going to use. Get out of our way, everybody. They don't have to justify that that's the actual way the goods flow, nothing. They just pick it. Okay? Okay, now, you come over and, can I hide this now? You get the idea of the flow here? Okay, so let's go back to our little example, okay, and let's use now the same exact facts, but now the company chose what? Chose LIFO, okay? Okay, so what happens? Well, let's go ahead and remember, for all these, we're going to figure out cost of goods sold and ending inventory, aren't we? Okay, so let's go ahead and let's do our cost of goods sold first, and they assume that they sold those ones which were from batch 3, right? Which was at the top of the pile. right? So we go back, we look, okay, batch 3, 3,000. Remember the fact pattern, guys. They had 0, they bought 9, they sold 4, and then they had 5,000 in ending inventory, right? So we need to make up for 4,000 items being sold right now. So they need to grab what? They need to grab all of these, don't they? The 475 ones? They're going to grab all of those because we got to make up a sale of 4,000 here. So 3,000 go out at what? 475, but we still need 1,000, don't we? Still need 1,000, so we go to batch 2, and when we go to batch 2 now, there were how many sitting there? 2,000, so we grab what, 1,000 of those? And if we sell 1,000, there's still 1,000 left, isn't there? Okay, and so when we come down and we get our cost of goods sold now, we price those next 1,000 out at the batch 2 price, 450. That's going to be what? That's going to be 4,500. Even I can do that one in my head. That's 1,000 at 450. We add those two numbers together. We get what? We get the 14,250 plus the 4,500. So our cost of goods sold is what? 18,750, right? Now we've got what? 5,000 items in ending inventory. We're going to do what? We're going to price out those remaining 1,000 at 450. That's from batch 2, right? And then what? And then the remaining 4,000 in ending inventory are those 425 ones. Those are the ones at the bottom of the pile, aren't they? And we assume they're still in ending inventory? Okay, and so when we go ahead and add the 4,500 plus the 17,000, we get 21,500. Is that FIFO? I mean LIFO? Okay. Question? Okay, good. Now, weighted average does what? Weighted average is the easiest one. If I'm giving you a question on the test, well, some test would give you a fact pattern and then make you go through without a multiple choice situation and ask you to calculate. Some tests like the CPA exam will give you a fact pattern and then say, give me cost of goods sold and give me ending inventory and LIFO, FIFO, weighted average. And what I tell my CPA students is if they do that, work the weighted average one first. Make sure you grab them points. CPA exam is all about accumulating points until you get a passing score, which is 75. So I tell my students, strive for 75, man. Don't worry about it. If anyone ever asks you what your score was on the CPA exam, just tell them you got 100. It's none of their business, right? Okay? Now, that's not an employer, but some nosy cousin or something asked you. And an employer won't ask you. Potential employer won't ask you. It's always a nosy, you're nosy, yeah, what was your score? I got 100. I heard they don't give hundreds in the exam. They gave one to me. Okay, right? Okay, so what happens? So I tell them to work the weighted average first because that's the easiest one. So we grab them points right off the top, don't we? Because the exam is timed. You only have 4 hours to work through something like 62 multiple choice questions in 9 task-based simulation in 4 hours of pretty complicated questions. So we got to grab the easy points first, don't we? Okay, so we would work the weighted average first because it's the easiest. Now for multiple choice, you're just going to go in the order that the multiple choice are given to you, right? But when you get a weighted average one, you should go, oh boy, this is easy, because what are we going to do? We're going to go ahead and we're going to extend everything out. The 425 times the 4,000, the 450 times the what? 2,000, extending that out. The 475, remember that batch 3? There was 3,000 in there. We extend that out. We add all those together, don't we? That gives us a total of everything we have in inventory. We add that up, gives us a total. We divide that. How many units did we purchase? 9,000, and that gives me a weighted average cost per unit, doesn't it? Okay, now somebody put that in your calculator if you haven't already. 40,250 divided by 9,000. What number do you get there? Read me that whole big, beautiful number. Two. Like that, to infinity and beyond, okay? And so what happens? We sit here and we go ahead and we do what? Carry this thing all the way out, don't we? So we have a weighted average cost per unit, right? And so if we want to know what our cost of goods sold is, we take that big old number times what? Times, how many did we sell? 4,000 is what we sold. Times the 4,000 that we sold. Did we sell 4,000? So we multiply that times 4,000. And that gives us this cost of goods sold of what? 17,889? Blah, 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 whatever. Okay? I'm more interested in these decimals up here because you can't get this number if you round it to the rounded number that I'm showing here. So can students get confused? Oh, why am I getting different numbers? Because the rounding is messed up. Okay? Messes it up. And then if we're trying to do ending inventory, we're what? 4.472 times what? Times the 5,000 items. Good. And ending inventory. And that gives us, and I wrote the number up here too, that gives us 22,368 and some change. Okay, I don't care whatever the number is you get. I'm tired of rounding. I wish they would destroy all rounding. Like God should just come down and make all numbers and stop having to be rounded. Okay? Huh? I don't care what it is. I'm tired of rounding. It's close to that number, right? Okay? All right, so what happens? Once you go ahead and you multiply that times what? Times the 5,000, you get some number for ending inventory, don't you? Okay? Okay, that's weighted average. That's a piece of cake. You just what? Add up the total of everything that you have in inventory, divided by the number of units you have in inventory. That gives you a weighted average number, doesn't it? To get the cost of goods sold, you multiply that by the number of units you sold. To get the ending inventory, you multiply that by the number of units you have in ending inventory, don't you? That's it. That's the easiest one because you don't have to sit there and say, okay, well, I sold these first, then these, right? Okay? Question? Okay, good. Now you come over with all that, and let's go back to the slides. Okay, and you have what? You have the last in, first out, and then you have, and they don't call it weighted average here, but it is weighted average because we weighted each one by the number of units we bought for those different prices, right? So that's weighted average. Okay, good. Now, balance sheet effects. What happens here? And I should probably just stay out of slide mode for a while. Balance sheet effects. What happens here? We say that a major advantage of the FIFO method is that in a period of inflation, the cost allocated to ending inventory will approximate their current cost. Okay, so for the balance sheet, FIFO gives us a better picture of what we're going to have to pay to buy more of those milks, right? If we're Safeway. We're talking about from the standpoint of Safeway. So the reason I wanted to go back out of slide mode is so that I could get back to my little pad over here. So they're going to report their ending inventory at 475, aren't they? Right? Because that's still sitting in ending inventory. And what did they most recently pay for those milks? 475. If the truck driver backs up and rolls over those milks and they have to replace them, what will be the cost to replace them? 475. And that's what we're showing on our balance sheet in ending inventory, aren't we? So the balance sheet has a better number on it, doesn't it, for our ending inventory? Okay. Now, when that's compared to LIFO, take a look at what's happening with LIFO. LIFO is sitting here, and the balance sheet is showing these 425 ones, aren't they? Where my ending inventory is. Meanwhile, on my income statement, where my cost of goods sold is, they're showing the most recent purchases as my cost of goods sold, aren't they? So when we're talking balance sheet, what happens? When we talk balance sheet, now we have the situation where LIFO is showing a worse picture on our balance sheet because it's showing that our inventory is only worth 425. Meanwhile, what? If we had to replace those rocks at the bottom, because can rocks get rotten? The rocks at the bottom got rotten, and we had to throw them away. We're going to have to do what? We're going to have to pay $475 to replace those, not $425, right? So there's a balance sheet distortion under LIFO, isn't there? Right? Okay.
You do it with like hay or grain, right? They pile up the grain, pile up hay, let's say it went rotten.
Right, okay. If the hay went rotten, does the hay go rotten? I come from Hayward, but I don't know anything about hay.
It gets wet, yeah.
Huh?
It gets wet.
Okay.
Moldy.
Okay. You country boy?
No.
Okay, so what happens? You're assuming, right? Okay, seems to make sense. Right, but whatever. Okay, the point is that what? Because remember, that we're not talking about the actual flow of goods, but if you're using LIFO, there's a balance sheet distortion, isn't there? Whereas under FIFO, the balance sheet is pretty much showing what I would have to pay to replace these items, whatever they are, right? Okay? Okay, good. Now you come over. Well, just let me click. Yeah. When we're talking about the income statement, now what happens? Well, now we're sitting here and LIFO gives us a better look. Oops. LIFO gives us a better look. I'm not going to underscore that. LIFO gives us a better look at what's happening with our net income. Why? Our cost of goods sold is including those higher cost items, aren't they? The 475 ones at the top of the pile. And so what happens? 475 minus the $5, we're showing a gross profit of 25 cents, aren't we? Which is about what our gross profit is because we are currently paying 475 per however many tons of rocks or whatever, right? Right? Okay, we're selling them for 5. We're paying what? We're paying 475. So FIFO is sort of giving us a funky, LIFO is giving us a funky look on the income statement, aren't they? Right? Meanwhile, what? If we sit here and we look at FIFO, FIFO is better because what? From the income statement accuracy standpoint? Because when you look at these now, what's happening? The items that are going into, LIFO is better, FIFO is worse. FIFO is worse because what's going into cost of goods sold? These 425 ones, when we're selling them for $5, and to replace those, we're going to have to pay what? 475. So FIFO looks better, it gives you a better look on the balance sheet, but it has an income statement distortion, doesn't it? Because I'm showing what? I'm showing a higher net income, right? I'm showing a higher net income when the reality is once I sell out of those 425 ones, I'm going to have to do what? I'm going to have to go and I'm going to have to buy new milks to replace those at 475 if I'm Safeway, right? This is FIFO that I'm talking about right here. FIFO is doing what? They're showing a gross profit of 475 right here is what I'm talking about. And they're not as good for the income statement because I'm showing a gross profit of 75 cents per milk when the reality is that I'm going to have to replace those milks that I just sold with 475 ones, right? Right? Okay, so this is FIFO is worse for the income statement. LIFO is better for the income statement, isn't it? So right here is LIFO, and we could have shown it right here instead of that other slide where I was showing you. LIFO is better for the income statement because we're sitting here and we're going to show what? $5 we're selling them for, those rocks, minus what? Minus the 475, we're showing you a gross profit of 25 cents per whatever, for the rocks. And that 25 cents is probably a better look at my gross profit because what? Because when I finally have to replace those rocks, I'm going to have to do what? I'm going to have to go ahead and replace them at 475, right? So LIFO is better on the income statement and it's worse on the balance sheet, right? Right? Which one do you like better, LIFO or FIFO?
I like FIFO.
You like FIFO? Why do you like FIFO?
Just because it's easier to keep track of everything if you're assuming it's...
Because it's easier. Okay, well, that's a good answer. That's probably the answer of most of those companies that chose FIFO, didn't they? Okay? But they probably carefully looked at it and determined that what? Determined that the additional cost of using the LIFO method was not worth the benefit of using the LIFO method, right? So the question becomes, why would, just going back to that little pie chart, why would some 24% of the companies, whenever they took this survey, and however they, I'm not vouching for this survey, who knows? Okay, they say major companies, whatever. I'm sure this was probably peer reviewed, and they looked at this. Shut up, John. Who cares? Safeway took the survey. Why would what? Why would 24% of these companies choose LIFO if it's harder? Yes, sir. LIFO gives a better look at the income statement to the users of the financial statements, right? It gives a better look, a more accurate presentation. Is that worth the additional cost, though, of using the LIFO? It's a dollar and cents things, guys. Huh? They don't have any reason to use LIFO? There's got to be a reason. If it's harder, yet 24% of the companies choose it, what would be the potential benefit to that?
Well, isn't it the consumer doesn't have a choice to choose one other than, like, for example, what I'm getting, I don't know if I'm right, with the milk, they have the choice to get whichever they want, but with the rocks, they have to get the ones on top. They have no choice.
No, we don't care the actual flow of goods. Get that out of your mind. The actual flow of goods doesn't matter. The company wakes up in the morning and they say, all of my goods flow out FIFO, but I'm going to use LIFO because I had a dream. God came down and told me to use LIFO today, and they're going to use LIFO. What?
Is it tax benefits?
Because of the tax benefit. Is that what you're going to say? Right? Because of the tax benefit. What's happening? If I'm sitting there and I'm doing what? I'm having a lower gross profit under LIFO, right? Because I'm matching those 475 ones against my $5. Lower gross profit, you know the way the financial statement works, lower net income, lower taxes, right? Lower taxes. And there are companies like oil companies and those that if they use LIFO, they always end up with a lower tax. And that's a lot of money to them because they make a lot of money, don't they? So for them, it's worth it to have a set of records where they keep track of LIFO, so they choose LIFO so they can use that for tax purposes. Huh? Yes, that's right. And because their cost of goods sold will be higher, right? And usually we have periods of rising prices. So since their cost of goods sold will be higher, their gross profit will be lower, their net income will be lower, their taxes will be lower, right? Okay, so why would a company ever use FIFO then? A minute ago we were thinking, why would they ever use LIFO? Now we're saying, why would you ever use FIFO?
Well, from a credit perspective or from shareholders, you want to show more profit.
Okay, if you're looking at it from a credit or shareholder perspective, ability to raise capital, showing a larger net income will do what? Attract more capital, right? Further, they may have determined that the tax savings is not worth what? The additional cost of keeping track of the inventory for LIFO purposes, right? Okay, but you're right. We're going to be showing a lower net income, aren't we, on our financial reports if we use LIFO, and that could affect our ability to raise capital. So why don't we use LIFO for our tax purposes and use FIFO for our book purposes? Why not?
You have a little thing here that says you can't.
That's right. There's something called...
No.
That's right. There's something called the LIFO conformity rule, and in the LIFO conformity rule, SEC and FASB say if you use LIFO for tax purposes, we're going to make you use it for book purposes. Okay? Now, something that I saw was kind of interesting. President Obama proposed in one of his tax policies. You think this is all just nerdy accounting issues, right? President Obama proposed in one of his budgets to eliminate LIFO as a viable method for accounting for inventory for tax purposes. So that what? So that you would go ahead and you would have to use FIFO, more income, more tax, right, coming into the federal government, right? Pretty smart, right? Because what happens? Who understands this, right? You'd have the Republicans out there would have to be going, oh, well, you see, what he's doing is, and everybody would be like, what are you talking about? What time's the game on, right? So that was something that he thought maybe he could slip by, right? But then I looked a little bit more on this, and I saw that there was this organization called the LIFO Consortium. And the whole point of the LIFO Consortium, their whole life was to make sure and lobby for the LIFO method to still be an allowable method to account for inventory. Okay? So if you find yourself on the LIFO Consortium at some point in time, I want you to check your priorities in life, okay, and do something else, okay? But what happens? This is a big deal, isn't it, in terms of the tax purposes. Now, remember we said that we have IFRS, International Financial Reporting Standards, and remember we said that the U.S. doesn't want to go to IFRS, or they can't go completely to IFRS because people will argue if they do. Well, IFRS says you can't use LIFO for financial reporting purposes. International Financial Reporting Standards have eliminated LIFO as an allowable method to account for inventory. Now, why have they done this? Well, go back to the rock guy. Go back to the rock guy. Think about it. So I wake up in the morning, and I just get to choose the method I want to use, don't I? So let's say I've been over here, I'm the rock guy, I've been using LIFO all this time, right? And then what? I wanted to go actually back to the slide. And then one morning I wake up and I decide that I'm going to switch my company over to what? Over to LIFO. Well, what do? I say, yeah, we're going to, not LIFO, but what? We were using LIFO, I'm going to switch over to FIFO. Strike that. Start over. The rock company's running without me. They're using FIFO. I wake up one morning and I say, we're going to switch to LIFO. So we switch over to LIFO, and then I tell them, in fact, I don't even have to sit there and switch over. We've been using LIFO. Let's just say we've been using LIFO. And I say, don't buy any rocks for a while. Just don't buy any more rocks from the rock supplier. So what's going to happen? All the 475 ones are going to be gone. Pretty soon all the 450 ones are going to be gone, and we're only left with what? The 425 ones, aren't we? And if we're only left with the 425 ones, what's going to happen? Now I'm showing a gross profit of 75 cents per. I look like a genius all of a sudden, don't I? Everybody says, oh, hire Lord. Why? Well, he comes in and he cleans house and he makes sure he made us get rid of all those inventory items that were sitting on the top of the pile. He really knows what he's doing because he said they were getting rained on. And, we had to get down to those bottom ones. Whatever excuse I get, I look like and that's why we have a nice big net income now, unlike we ever had before. Isn't he a genius? Meanwhile, what happens? Here come the stockholders. Oh, look, the company's coming back. This is pretty good. They buy the stock. I take off and I go hang out with the Wells Fargo guys for a while on our island somewhere with my big bonus. And then what happens? By the time anyone figures out what's going on, I'm sitting over there in an island. Now this company's stuck with having to replenish their inventory at what could be even higher prices now, right? And all of a sudden, they're going to be in a fix, aren't they? Okay? And so IFRS looked at all that and said, we're not going to play that. We're not going to let you choose your inventory method, whatever you think's going to make your bottom line look like what you want it to. So they said no to that. Why didn't the U.S. follow? Because if you don't use LIFO for reporting purposes, you can't use it for tax purposes. And so the LIFO Consortium will go to Congress and say, if you allow the U.S. to go over to IFRS and get rid of LIFO as a good inventory method, the terrorists have won. They'll say whatever they need to at that point in time to what? To get everyone off of this idea of switching over to IFRS, right? Okay? All right. I saw Bernie Sanders, the other Bernie, on the TV the other day, and he said, and it kind of had to think about it for a minute, he says, well, they said, well, can't they stop fraud? And he says, how? The system is built on fraud. He says what the companies do is they commit the fraud and they wait to see if they get caught. And if they get caught, they just pay the fine. I mean, the whole system is fraudulent. So how do you stop a whole system that's built on fraud, essentially, right? How do you stop fraud when the whole system is built on it? But all of this goes into it. Now, this isn't fraud. This is using the rules to your advantage, right? Okay. Okay, good. All right. So let's go ahead and let's look at this now from the standpoint of some questions. The cost flow method that often parallels the actual flow of goods is what? Is going to be FIFO. Good. Okay, let's take a look here. In a period of inflation, the cost flow method that results in the lowest income taxes is what? You better not miss that one if that's on the test. Life is LIFO, right? Okay. Okay, good. Let's see. Let's come back to this. Okay, what I want to do at this point, we'll come back to these, but I want to go to some of the multiple choice questions. Okay, some of the quiz questions. Which one do I want to do first? You want to do Netta Shutters, or you want to do Chapter 5 quiz with answers? You took too long. Okay, so we're going to do this one, okay? And I know you have like, you're like, oh, no, I want to do Netta Shutters, but come on now. Okay, this is Chapter 5 quiz. Keep going. Oh, you got it? Okay. Okay, ready? Does this look familiar? So we have our first year of operations, and we purchase our entire inventory in what? 3 batches, 3, 4, and 2. What's the total? They bought 9,000. And how many did they sell? They sold 5,000, didn't they? So this is almost like that question, just a little bit different, right? In the other one, we sold 4,000 and ended up with 5. Here, what? We sold 5,000 and we're going to end up with what? 4,000, right? Now, I couldn't understand when I gave this test to one of my classes. I had given them that same example that we just studied with, and then this was their test. And everybody went, oh, you really changed the problem. I did? All I did was change what got sold. Everything else was exactly the same. Okay? Anyway, so let's go ahead and let's do weighted average first. Who wants to help me with weighted average? You want to help me with weighted average? Okay. 425, good, times 3,000. I'm just going to write it all in here. 4,000 times 325, you say? I mean, times 425 gives me what? 3,000 times 425 gives me what? 12,750. Okay, good. 12,750, right? Okay, good. Next one. 4,000 times 450. 18,000. Good. Then the 2,000 times the 475. 9,500. Nice. Okay. Now what do you want me to do with those? Add these up. And you get a total of 40,000 what? 250? Is that right? Okay. 40,250. Okay, now what do you want me to do? 40,250 divided by 9,000, you say? Okay, good. And that gives me what? 4.472222 on into infinity. We'll just do 3 twos. Okay. All right, good. Now what do you want me to do? They want to know the cost of goods sold. Take that number, multiply it by the number of items sold, 5,000, right? And that gives me something close to this 22,361. Good. You want to do the ending inventory? The next one? So now I got 4,000 left in ending inventory. Good. Good. And that gives me what? 8889 there, give or take. Right? Okay, good. Very good. You want to keep going to the next one? Okay, let's go ahead and let's do that one. Cost of goods sold, now using FIFO, and then ending inventory using FIFO, right? Okay, good. Okay, I sold 5,000, so I'm going to take 3,000 from those right there, right? Okay, good. 3,000. Those get sold first. That's what, 425 ones? That gives me 12,750. Good. 2,000 from batch 2 at 450 each. That's what, 9,000? Right? So how many are we left here with now? 2,000? So there's, huh? Right? Yeah, okay, so there's 2,000 left there now. Okay, and so for our cost of goods sold, though, what do we have here? 21,750. That number right there? Beautiful. You want to do want to do ending inventory for me, I mean? We have 1,000 from batch 2. Did I make a mistake up there? What did we do wrong? Did I do it wrong? 2,000, 5,000. 5,000 got sold, right? Was it 5,000 got sold? 2,000 left from batch 2? Okay. 2,000 from batch 2 at what? 450? So that's 9,000? Okay. And how many from batch 1? How many from batch... from batch 3, sorry. It's all those are left, right? Okay, from batch 3. Sorry, I slipped into a LIFO thing here. 2,000 from batch 3 at what? 475. 475. How much? And that gives me the 18,500. Good. You mean like my goods available for sale minus my cost of goods sold, you're saying? Will equal ending inventory? Let's try it. 40,000 what? 250 minus the what? Cost of goods sold, which we had calculated as 21,750. Hello? Gives me 18,500, you're saying? Okay. That'll work too. What I had available minus what I sold or minus what I have left means I must have sold the rest, right? Okay, good. How about cost of goods sold using using LIFO? Who wants to do this one? Person who made eye contact for more than 3 seconds. Oh, you want it? I got people beating each other up over this one. I'll let you do this first. I'll let you do the ending inventory. You're going to get the first one on the next question, on the next test. Okay? So number 5 is all yours. So we're looking for cost of goods sold using LIFO. How many did we sell? We sold 5,000 cost of goods sold. So which ones do you want to grab first for the solds? Batch 3, there's 2,000 there, right? So I'm going to pick up 2,000 at 475. $9,500, you say? Okay. Okay, good. Then what, I sold a total of... So now I got to go to batch 2, and I'm going to take how many units from there? 3,000, right? Because what, that 2,000 I put in there was from the last problem, right? That's from the last problem? Assuming this stupid thing's going to let me erase it. Okay, so now of the 4,000 that are there, because I need 3,000 more, I'm only take 3,000 of those to bring me to 5,000, right? So I grab 3,000 of those. Okay, I hear you, but the computer doesn't. For some reason, it's going to go ahead and lock me up here and not let me get down there. Ugh. I got to talk to it? Gently or in a mean way? Come on, computer. If you don't work on no ice cream after class, no milkshake for you. Was that gentle? Or was that mean? Okay. So you wanted me to talk gently and it worked. See? Okay, so what was it now? 3,000 from batch 2, right? Because there was 4,000 sitting up there at 450. 13,500. Okay. So do I have my 5,000 items sold? And so I add those two together. That gives me what? 23,000 even? Okay, good. All right. So now we want to get ending inventory, right? The remaining 1,000 units from batch 2, because we went up there and we had 4, and we just got rid of 3, didn't we? So we only have 1,000 of those left now? Okay, good. So 1,000. I'm just going to do it up here, so this stupid thing. Well, yeah, 1,000 times what? Times 450? It's 4,500. Okay, good. This is for ending inventory, right? And then what? Now we get those 3,000 units. 3,000 units from batch 1 at what? 425. Good. And those are going to come in at 12,750. And so I add those together. What's that? 17,250, you say? Okay. And let's see if it'll let me scroll back down properly. What number was that? Number 6. So 17,250, right? Okay, good. Good job. Don't worry about this question. This was something that I used to make my classes do that I learned better. Not to ask. Don't worry about this. I don't want that on tests anymore. But I do want you to be able to answer this one. So, Aloni, sir with the Aloni College, sir, what's your name again? Jeremy. So, what's the gross profit if I use FIFO? Okay. Where'd you learn that trick? In Hayward? Okay. So $5. You're sitting too close to them Raider fans now. They're starting to have an effect on you. Okay, so it's $5 is the sales price minus what? Minus the cost of goods sold. Very good. And the cost of goods sold, excuse me, up there for the FIFO question was what? 21,750. Is that what it? Huh? Well, we need $5 times what? Times how many units did they sell? Times 5,000. So what's that? 25,000. So 25,000, and then you're saying the cost of goods sold from the FIFO problem was what? 21,750. You had to pull up from that question, right? And so that gave me what? 3,250. Okay, good. Can you do it for LIFO? Sales price? Sales price is still 25,000, isn't it? Good. But now we're going to do what? Subtract the LIFO cost of goods sold, which was 23,000. Periods of rising prices, right? So notice LIFO is going to give me a smaller gross profit. What, 2,000? Smaller gross profit, which will translate into a lower net income, which translate into lower taxes, right? And since we typically have rising prices, eventually over time all prices will go up, right? And so we go ahead and most companies that have a perceive a tax benefit will use LIFO. Okay, good. You want to take the break or you want to keep going? Break time? Okay. Okay, let's go ahead. Let's take the break, guys. Let's reconvene at what? What time does this class get out? 8:45. So let's reconvene at 7:45. That'll give us a full hour, right? We try to knock out some more material. 10 minutes? Okay. Just the test. So we're going to look at lower of cost or market here. And lower of cost or market is a pretty easy concept in that the name is very descriptive of what we need to do when we do lower of cost or market considerations. You're welcome. When we do lower of cost or market considerations. Okay, so what happens? We purchase an item for $5,000, an inventory item. The value of that inventory item drops down to $4,000. FASB says that we will need to take a loss and lower that item down to that lower market in that situation, right? Bought it for 5, market is now 4. If what? If we buy something for 5 and the market goes up to 6, we still carry it at 5, right? Lower of cost or market, whichever is lower, that's what we carry our inventory at. Okay, so it's just this easy, guys. Cost is 60,000, market is 55. What should we carry it at? 55, lower of cost or market, right? Okay. Okay, good. What happens here? Satellite radios. Cost is 45,000. Market's 52. What should we carry it at? Stays at 45 the market, right? Okay. DVD recorders, please. 0 for these, right? Okay, but what? DVD recorder at what? 48 cost, 45 market, we carry it at? 45 market, good. DVDs, 0. Okay, what? 15, 14, we carry them at what? 14, right? Okay, it's just that simple. If you're waiting for deeper meaning, stop. There is none, okay? Rule of conservatism says what? Take the loss immediately, right? Okay. Okay, good. Presentation on the balance sheet. Inventory is classified as a current asset. Inventory is what? A current asset, right? And we know that cost of goods sold is on the income statement. Please, we're not children, right? We're not babies here. Okay? Right? Okay. Okay, good. Now we come over and let's do an analysis here of inventory. Okay? Let's say you want to know if a company is able to sell its inventory. What sort of an analysis would you do if you're trying to figure out that a company's trying to sell its inventory? Well, you might want to figure out how many days an item stays in inventory. And so what you're going to do is you're going to first figure out how many times do they turn over their inventory. The inventory turnover is your cost of goods sold divided by your average inventory. Average inventory is your beginning inventory plus your ending inventory divided by 2 will give you your average inventory, right? Okay? Then what? Once you have the average inventory, you divide that into your cost of goods sold. That says how many times you turned over your inventory. Once you know how many times you turned over your inventory, if you want to know how long something stays in inventory, you divide that by the 3 into the 365-day year, and that will give you the amount of days that items have stayed in inventory. So let's just use an example, and let's say that this company has what? Has 36,318 of beginning inventory, 32,713 of ending inventory. They divide that by 2. That gives us our average inventory, right? Okay, then what? Then you divide that into your cost of goods sold, and that means they turn their inventory over what? 9 times, right? So if our average inventory was, what is this 36,318 plus 32,713 divided by 2 anyway? Huh? 36,318 plus 32,713. Don't worry about the zeros we're dropping here. Divided by 2 is what? 35,000 what? 515.50. Okay, good. So that means that on average, they had $35,000 worth of inventory, didn't they? And if they sold what? $315,000 worth of merchandise, that means that what? 35 times they sold out their whole inventory, didn't they? Because they averaged 35,000? Not 35 times, what I say? 9 times they sold out their whole inventory, didn't they? Right? Okay, that's the inventory turnover. Huh? That looks about right. 35,515 divided by 315 is in... I don't care. It's in the ballpark, okay? It's around 9. Okay, I don't care. I don't care. It's about 9 times, isn't it? You're not sitting here trying to get this number perfect. The bottom line is what? They turned that inventory over about what? About 9 times, didn't they? Right? Because if you have on average 35 and you sell 350, it's 9 to 10 times, isn't it? Okay? Now, since they turned it over 9 times and what? There are 365 days in the year. If you take this 365, divide that by what? 9.1. Don't you get this 40 days? If I turn my inventory over 9 times and there's 365 days on average, stuff stayed in inventory for about 40 days, didn't it? Is this good or bad? If this is a sushi restaurant, don't eat there. This is really, really, really bad, okay? If this is Walmart, I don't know, I don't go to Walmart that much, but I usually, buy stuff that's probably going to be on like a 40-day cycle, right? So it sounds about right for them to turn things over every 40 days, right? If I'm a commercial real estate sales company or something, well, then what? Then my stuff might stay in inventory a little longer, right? I mean, 40 days would be phenomenal performance, wouldn't it, if they could actually sell inventory of real estate in 40 days? So we might expect a longer for real estate sales or something, right? Okay. Question? This allows us to evaluate the company? Turnover, well, it depends on what you're talking about. If you're talking about Apple turnovers, there's really good things that go well with a cup of coffee, okay? But if you're talking about inventory turnover, it means what? How many times we what? How many times we turned over the inventory? How many times did we sell out the inventory? That's maybe another word you could use. So we sold out, although we would never let ourselves sell out because what? This is another thing you could use this analysis for. About every 40 days, we better be getting another shipment of stuff, right? Right? Because in 40 days, we're going to be out. So what happens? We could use this analysis, and we probably wouldn't wait 40 days. But we know by about the 25th day, we better be getting another shipment of them, crackers that everybody likes, right? Because if we don't, we're going to run out of those by the 40th day. And what? You could do this by product, right? And people are going to go and say, what? They ran out of crackers again? I'm never coming back here to watch my crackers. I'm going over this. That's the guy leaving, and we're never going to see him again, right? That's me going to Lucky's for avocados. Okay, whatever. So what? So if you're sitting there and what? You stock out, that's a problem. By the same token, you don't want to order stuff every 10 days because now what? Now you got crackers falling off the shelves in the aisle. People are stepping on them. Oh, sorry. Why is it in the aisle? Hey, Joe, take some of these crackers home. Can you believe it? They're falling into the aisle. Okay, whatever, right? And so what happens? We don't want to order them sooner, so we'll find a perfect point to order these. Now, we could turn this as a very rough formula. If you start taking like quantitative business methods and that when you transfer to the universities, they'll make you take more sophisticated means. They call them just-in-time inventory methods, in which you can use a calculus type formula to figure out what the economic order quantity is, when you should order, and how much you should order at any point in time. But this gives you a ballpark idea of it, doesn't it? As well as an analysis. If you're looking at a company and you're saying, 40 days are the amount of time that things stay in inventory. And I look at every other company in this industry and it's only 20 days. What's wrong with these guys? Why are they 2 times slower than everybody else, right? Price too much, or maybe their stuff is lousy. Or maybe somebody's invented something that's better than that stupid thing that used to be so great for them, right? Whatever. You start uncovering a lot of things through this. Okay? Okay, good. Gross profit method. Okay? Oh, I shouldn't do that. Makes you think. It seems like such a waste of time for you guys. And I can't. Never mind. Shut up, John. This is a really cool method, okay, to account for inventory. All right? So let's just go ahead and let's take a look at this. And all you do with the gross profit method is we'll give you the gross profit percentage for the inventory. Let's just go back. It gives us a means to estimate our ending inventory. That's what we're trying to do. We're trying to estimate our ending inventory using gross profit method. So what do? We sit here and we have to take our net sales and then we take our estimated gross profit, and they tell us in this problem that last year their gross profit was 30%. So if last year their gross profit was 30% and this year their sales is what? Is 200,000, then that means that they think their gross profit this year will be 60,000, right? Sales now minus gross profit equals my cost of goods sold, right? The complement of sales minus cost of goods sold gives me gross profit. So sales minus gross profit gives me cost of goods sold. And I then just sit there and I say, okay, my beginning inventory plus my purchases for the period gives me my goods available for sale, less my what? Estimate that I just came up with for my cost of goods sold. So I estimate my ending inventory is what? 20,000, and I base that off of retail. Okay? Okay, gross profit. Okay, so with that, what I want to do is go back and let's take a look at a couple of those Chapter 5 quiz questions that we hadn't finished from before. Yeah, we are. Don't scare me. Yeah, we're recording. Okay. Okay, good. I don't want all my genius thoughts to be lost, right? Okay. Okay, so let's go ahead and let's take a look at this one now. And this is trying to get the days in inventory, isn't it? Okay. Who wants to try this one?
We're not going to do 12.
Yeah, okay. You want to do 12?
No, I'm going to do 12.
You want me to do 12? Okay, you got it. All right, so what happens? This Switzer Inc. has 5 computers, which are part of their inventory for 2 years. Each computer after 2 years, these computers are worthless. Come on, okay? But we'll humor them, right, and pretend like you could carry computers in inventory for 2 years and have any hope of selling them. But anyway, let's go ahead and let's take a look at this. And so we have what? Each computer cost $600 and originally retailed for $9. A statement, that's the financial statement date. Each computer has a current replacement cost of $400. So do you want to value these at 6, 9, or 4? 4, right? Lower cost or market. And our markets come down to 4. So 400 times how many computers? Times 5 computers gives me $2,000. Okay. Question? Okay, good. How about this one? Who wants to do 13? 13. How about this side of the room? Well, you carried your side for a little while there, but how about the middle? You want to do this one? Okay. Go ahead. That's all I ask is that you try. If you try in here and you get it wrong half the time, that's a 50%. You take that home and you get it right 3/4 of the time, that's a 75. You try it again for the practice midterm that we'll have, and you get them right 80%, that's an 8 out of time to that. That's 80%. And if you get it right on the test, that's an A in this class, isn't it? Okay? So go ahead, get started on that journey. Well, it's days in inventory. We just looked at this, right? Do I have to? You came in late. Okay, even better. Now you really got to do it. Now you can't stop doing it if I don't want to let you stop. Okay, so what happens? We got to get the average inventory first, don't we? Okay, so just look right here. So we take the 90,000, right? plus the 110. That gives me what? 200,000 if I'm not messing my calculation up here? Okay. 200,000, and to get the average, you divide that by 2. I mean, that's just how you get the average, right? Okay. And so what happens? We get the average for the year anyway. That's how you get the average. And that's 100,000. Right? Okay. And so then what? Then once we got the 100,000, what do you want me to do with that? Good. We're going to divide it by I should say, the cost of goods sold, right? So 500,000 divided by what? 100,000 means that this company turned over their inventory how many times? 5 times, right? This is a little clearer now about this turnover, sir. What's your name, sir, that asked that question about what does turnover mean? Huh? Andrew, you said what does turnover mean? Now you can see it a little more clearly with this number that 5 times they had to replenish their inventory, didn't they? To be able to sell 500,000? Because it on average was hovering around 100,000 throughout the year, right? Okay, so if we turn an inventory over 5 times, and there are 365 days in a year, that means that what? Every 75 days, right? Or so? 73 days. Okay. Every 73 days, we must have had to sell out our inventory and replenish, and maybe we started ordering more inventory at about 60 days, where we don't wait till the 75th day, right? Or if you're an analyst, you could look at this and you can say, hey, 75 days, and everybody else in this industry is taking 120 days to move their inventory because it's something that's hard to sell or something, or it's a down market in real estate. Or 75 days for a restaurant? Forget about it. That's the bad news, right? Just depends on the company, I should say, right? Okay? Okay, good. Oh, huh? That's it for that one. But we still have another midterm, don't we? What is this now? I can close that. Okay, we'll close the program then. Well, don't recover my information. Just let it go. I mean, since you messed it up now, you don't need to recover anything. That's me talking to Microsoft Word. So I'm looking for what? This one? Now it's going to go through this whole thing and say, do you want these files back? We found them. And it's going to give me everything but what I want, which is this. Okay. All right. So let's look at some of these now. And these questions are pretty similar to what you can expect to see on your exam. You want to do these now or later? We could save these for later if you've had enough inventory. Now that I built it up so much, we have to do them now, right? That was the dream. That was the dream, but that's not really realistic now, is it? So let's just do this and get it knocked out. Because we don't really have the appropriate time. We're not going to do that other chapter. So let's just do this like this. What am I trying to do here, though? Home, view, zoom, page width. Okay. Let's just do this. Okay, and I'll do the first one. Then I'm going to start to ask for some help. Okay, so let's just go ahead and let's take a look at this one. And they're asking us here what? The cost of goods sold. Hello? Okay, so since they're asking me cost of goods sold, let me see. I think I'll get red here. And maybe I'll do this heavy blue. Okay, so they're asking me what? Cost of goods sold? Okay, so they're asking me cost of goods sold, and they tell us that there are 45 units on hand. Okay, and we're using specific identification. And ending inventory consists of 10 units from each of the 3 purchases. And so they want us to consider the cost of goods sold, right? So if we want to do cost of goods sold, and each inventory includes what? Each purchase includes only 10 items left. If there's only 10 items out of a purchase of 60, that means I must have sold what? 50, right? Okay, and if they're telling me what? There's only 10 left after a purchase of 30, that means I sold what? 20. And if they're telling me that there's 10 left after a purchase of 45, that means I sold what? 35. Good. I go ahead and I do the extensions. Does that give me the answer? Okay. Right? Okay. Now, just for fun, I went ahead and I did the ending inventory down here. Okay, and they tell me in the fact pattern what? There were 15 units from the November 1st inventory. So I know that those are all still there, aren't they? 15 times and I just picked up the $8. Gave me that $8, right? So that's for that one. And then they told me that there was 10 units, I should say, each for those others, didn't they? So I just went ahead and I said, okay, that means that the ending inventory got to be what? 375. The question didn't ask that. I just decided to go ahead and calculate it, right? Okay? Okay, good. Now the company uses what? FIFO, and they want us to do what? Ending inventory, and they tell us what they bought and then what they sold, right? Okay, let me erase some of this if I can. Will it let me erase it? I don't think it will. Oh, okay. Well, thank you. Okay, so let's go ahead and let's see if we can figure this thing out now with some of this stuff, some of this junk in the way, so we can see what went on here. I hope I haven't erased so much that even I can't figure it out now. But what's going on here? Okay, so we want to know the ending inventory, don't we? On a FIFO basis. And so what happens? They have these 10 units in beginning inventory. They have purchases of 60, and then they sell 40, don't they? Right? So when they sell those 40, what are they going to do? They're going to first sell all of these, aren't they? Right? So they're going to sell what? What are we looking for? Ending inventory? Okay, but we got to figure out what's gone here to get ending inventory. So all of those 10 are gone, aren't they? Okay. Then what? Then they go ahead and they sell 30 of these, right? So there's 30 left. First in, first out. Did that give me my first 40? Right? Okay. Then they buy 30 more and they sell 28. So if we're doing first in, first out, which one should we grab first? We grabbed 28 of those, so there's only what? 2 of those left now, right? And we sold all 28 of those using first in, first out. So if you look over here then, in our ending inventory, we've got what? We've got 2 of these 92s. And we've got what? We've got all 30 of these 95s. Right? Right? You think that textbook's going to start talking to you now and explaining this to you?
No, I was looking for a note that I put in my backpack.
Oh, I thought you were looking through the textbook trying to see if it's going to start talking to you.
This is
Oh, okay. Is there a question on this? Okay. Question? No? How about cost of goods sold? Who wants to talk me through the cost of goods sold? Guys, look, tuning out, if you're sitting here and you're saying, just close your eyes and this will all be over in a minute. I mean, that's not what's happening here, okay? I mean, the point of this is to have your eyes open and understand. And if you don't understand, this is the time to go, Doc, every time I do this, I got a pain. I don't know, man. I'm going to think maybe I'm dying. I mean, you don't go to the doctor and say, well, I went to the doctor, but, in the way into the doctor's office, my brain fell out, but I didn't tell him. I mean, How did I get 30 that came from this sale, right? From this sale when I left was 30? When I was left with 30 before I crossed it out, you mean? This 30 right here? Where I crossed it out later? Here, I'll just do it again. Let me just erase it. So it's easier to see if I erase it first. Okay, I guess it's erased now. Oh, please, wizard of the erasers. Okay, that's what I needed to do. Okay, all right. So what's happening? They said that they sold 40 right here, didn't they? Okay, so since they sold 40, where do you want me to get those 40 from using first in, first out? Where do you want me to get them from? Just talk me through it. Right, first in, first out. So I need 40, don't I? Okay, well, you asked me where I got the 30, and now you're answering a different question than the way I explained it. Okay, well, for the rest of the audience, I'll go ahead and I'll show them what we're doing here. So we went ahead and we got rid of the 10, didn't we? Right? Okay, so that's sold, and now what? Now we need 30 more to make it up to 40, don't we? Okay, so we go ahead and we sell what? We sell 30 of those, and so we're left with 30. That's where that 30 came from, right? Okay, and then the problem told me I sold 28, so I went up here and I sold all but what? 2 of those, right? Okay, and so now I'm left with what? I'm left with 2 at 92, and I'm left with what? 30 at 95, right? Okay, and that's how I got the what? They asked me for ending inventory here. Okay. Any question on the other one? Cost of goods sold, where I just put it in there. They didn't ask for it, did they? Did they ask me for cost of goods sold? I just count. Oh yeah, I typed that in is what it was. The original problem didn't ask for it, but I just went ahead and typed it in. Did we do cost of goods sold? Oh, okay, let's do cost of goods sold. So cost of goods sold is what? I sold those 10 at 90, right? And then I sold these what? These 30 at 92, and then I sold 28 of those, because remember I ended up with 2. I sold 28 of those also at 92, didn't I? To get the cost of goods sold? Right? Okay. Okay, good. Who wants to do Pappies? Ending inventory using LIFO. Go ahead, walk me through it. Go ahead. Yeah, you want to do it? Okay. Okay, good. Let's try it. So LIFO, right? So last in, first out. Oh, you know what? This one's kind of a hard one. I'll tell you what. I'll do this one, and then you can do. I'll do ending inventory. Then you can do cost of goods sold. How's that? Okay. So this one's a little bit harder. Let's just take a look. They tell me that what? I had beginning inventory of what? 10. The reason I'm doing it because it's got a little bit of a wrinkle in it. I don't want you to get stuck in the middle of that. Destroy your feeling that you understand this that you don't understand it when you do. Give you that feeling. So let's just look at it. Okay, and they start out with 10, and then they did what? Then they bought 60 more, and then they sold 40, didn't they? Okay. Now, at the point that they sell it, if you're using a perpetual inventory system, you have to debit cost of goods sold and credit inventory after each purchase and then sale, don't you? So at this point, even though they bought some stuff after this sale, they got to update the inventory record, so they have to go and grab those what? Those $92 ones? Because that's using the LIFO. That was the last that came in. Right? So they go ahead, and since they sold 40 of those, that means that there's only what? 20 of those left right now, right? Okay? Then they go and they buy what? They buy 30 more units. And so what happens? Now when they sell 28, they do what? They take the 28 from that purchase that they just had, don't they? Right? And so now there's only what? 2 of those left? And so since they're asking me ending inventory in this problem, it's what? It's the beginning inventory items, 10. They didn't sell any of those, presumably, under last in, first out, right? There's 20 of those 92 ones left, because after that purchase of 40, that was the only cost that was in there. I mean, after that purchase of 60, and then the only cost that was in there was that 40. When they sold them, they had to grab those 40, right? So there's 20 of those left. And then what? And then they bought those 30 more, and when they sold 28, they assumed that they sold all but what? 2 of those, right? And so we go ahead and we do the extension there, and we get this 190. And you add that up, and that's the ending inventory. Right? So that one's a little trickier. That's why I didn't want to get you stuck in the middle of that one, because of that wrinkle of the purchase coming before the next sale, right? Okay? Okay, good. Now, if you want to do cost of goods sold, it's really the complement of this. It is what? It's 40 of those that got sold right there, and then what? And then the 28 of those that got sold, right? Right? Okay. Okay, good. Let's see if there's another one we can do. Oh, boy. Who wants to do this one? You want to try this one? No, why? This is an easy one. You can do it. It's easy. Sorry. I'm just kidding. Come on, guys. This is a piece of cake now. It's lower of cost or market, isn't it? So you pick up the lower of the cost or the market. Hello. Okay, and so what happens? You sit here. What's lower? What's lower? The 19s. Okay, good. What's lower here? Well, they're the same, so we got to pick the 45. What's lower here? 59. What's lower here? 36. And then you just simply do the extensions, don't you? Down here, taking these numbers. Okay, now this problem, guys, I won't give you one like this on the test because this is a full-blown problem, but I thought it was a pretty good exercise, so that's why I grabbed it. Okay, you'll have obviously multiple choice question, right? Okay, good. We're going to do that next time. We'll come back to this one. I'm not making you do that now. I think that's why I put that smile there before. Okay. Let's see here. Don't save. Yeah, don't save. Close that. Don't save. Good. Here we go. Chapter 7. We're going to go for it. Let's see where we land. Let's see where this flight takes us. What time is it? Okay. All right, let's see where we end up here. All right, so we're going to go ahead and we're going to consider receivables. We are interested in accounts receivable and notes receivable, right? Okay. Now, you know from our study of previous chapters that when we have a sale on credit, we will debit what? Debit the accounts receivable, good, for say 100,000. And credit what? Sales, whatever, for 100,000, right? Right? Why do we do this? Why do we let people take our product or our hard work and walk away and then we say, no problem, pay me later? Why do we do this? Well, why do we extend credit? They'll come back to us if they need more, or they'll just buy our stuff now because maybe they don't have the cash, right? And we trust them that they will pay us later, right? Okay? How would you make sure they're going to pay you later? Huh? Apply penalties if they don't? What are we going to do? Go to their house and show up with the orange cone? Say, hey, where's my money, man? What kind of penalties?
Interest.
So we're going to check their credit. So we're going to go to God and say, God, is this person worthy? And God will come down and say, yes, my son. Huh? There's no guarantee, right? So since there's no guarantee, now we're doing this because what? Maybe they don't have the cash, but we trust their ability to pay. But when we're doing this, there's always a chance that somebody won't pay us, right? And does this ever happen? This always happens. It always happens. The only way you avoid a situation of not collecting money for your services is by doing what? Cash only, right? And then you know that you're going to get the money for your services, right? If you extend credit, I guarantee you somebody is going to not pay you eventually, right? So, FASB knows this too. And what they tell a company is when you go ahead and you debit the accounts receivable and you credit sales, you have a responsibility to at the same time make an estimate of what you think you're not going to collect. Isn't that a drag? At the same time that you're all happy that you got this sale, you need to look into the future. Well, really, you look into the past and see what percent of the time when I make a sale do I not collect on it, and some of that you have to assume you're not going to collect right up front. So if I am assuming I'm not going to collect some of this, what journal entry do you think I should make? I'm not going to collect 1%. I know that 1% of that receivable I'm not going to collect. What do you want me to do with it? Add it on to the receivable if I'm not going to collect it? Oh, you said bad debt? Okay, so if I have a bad debt potential, what do you want me to do? If I know I'm not going to collect $1,000 of this receivable, say 1%. You want me to take a loss? You want me to take a loss? Okay, so I'm going to debit loss. Is a loss a debit or a credit? I'm going to debit loss, okay, for $100. What was it? 1% is 1,000, I mean. Okay, good. I got to credit something. What do you want me to credit? Cash. How can I credit cash? Did I spend any cash? Okay. You want me to credit accounts receivable since I'm saying I'm not going to collect that, right? Is that the journal entry you want? Is that no? Just go ahead, stick with it. Okay. So now I'm saying at this point what? That my accounts receivable is 99. How much is it, guys? I can't think. 99,000. Is that what you're saying? You're saying my account receivable is 99,000? So, hey, look, we just did a journal entry. If we debited and credited something, don't start worrying about other accounts. We're good. Everything's going to still balance, right? Okay, so don't worry. I'm just asking you. We sat there and we debited accounts receivable 1,000, so account receivable is 99,000 now, isn't it? Is that right? Okay. Now, if this was the only transaction we had the whole year, we had a sale of 100,000 on credit, and we assumed that we weren't going to collect 1,000 of that, right? When I prepare if this is my balance sheet is going to show what? Is going to show accounts receivable 99,000, isn't it? And my income statement is going to show sales of how much? Sales of 100,000, and then you said you wanted to take a loss. You wanted a loss, and a loss is going to be a subtract. It's like an expense, but we call it a loss here. You're saying $1,000. Okay, and so we have net income of how much? Net income of 99,000, don't we? And if this was our first year of operations, then our retained earnings is going to be what? 99,000, right? So the balance sheet's going to balance. So look at that. You got us kind of there, didn't you? Okay. Well, look, the reason I say kind of, let me ask you a couple questions. First off, is that really a loss? Is that really how we should classify that, as a loss? Is losing money on a sale a normal course of business thing? Is losing money on a sale a normal course of business? It's not? Not being able to collect on a receivable is not a normal course of business? It is a normal course of business. FASB has defined it as such. They say that if you're doing credit sales, it is a normal course of business for somebody not to pay you. And if you want to avoid that eventuality, take cash only or pray for world peace. Those are your options, right? Okay? Okay, so what happens? Something's going to go wrong, isn't it? So that's a normal course of business is all I'm trying to get you to agree to here, right? Okay, so that's normal course of business. So that means that it's not really a loss at all, is it? If it's normal course of business? Normal course of business things that reduce net income, we call those expenses, don't we? Normal course of business is an expense. So how about if I debit bad debt expense, BDE, bad debt expense for 1,000? Can I do that? You okay with that? It's not going to really change the outcome much here. It's just that we properly classified it as an expense, not a loss, right? Right? Okay. Now, you credited the account receivable, didn't you?
Yes.
You credited the account receivable because you're saying, hey, we're not going to collect it, just credit the account receivable, right? If we have 100,000 of accounts receivable and we have 10 customers that each are going to pay us, what would that be, $1,000? 10 customers are each pay us $1,000. Is that up to the 100,000? Okay. 10 customers that are going to each pay us what? 10,000? 10 customers each can pay us 10,000. 10 customers each can pay us 10,000. That's 100,000, isn't it? And you're saying we're thinking 1,000 of that we're not going to collect? Which customer? We don't know which customer it is. We're not going to sit there and go, I think it was that guy who kind of walked in like this. He's the one that's not going to pay us. Well, then why'd you offer him the credit then, right? So we don't know who it is, right? Right? So if we sat there and we have Adams and we have Burns and we have Calero and they're each owing us 10,000, that's called a subsidiary ledger. And that subsidiary ledger, it's got to add up to 100,000, right? That's got to add up to 100,000. We might have maintained that in our general ledger, in our accounts receivable, also has to add up to 100,000, right? So we can't credit the receivable because now the subsidiary, the detail, won't match what? What's up here, and we can't choose one. Yeah, I think it was that shifty-eyed guy's the one. We can't sit there and do that, so we got to find another account, don't we, that we can credit here? We can't credit accounts receivable, right? Because if we do, accounts receivable going to show 99,000, but we haven't adjusted down here for the particular customer because we can't because we don't know who's not going to pay us, right? So what do? We come up with another account that we credit, and we call that account now allowance for doubtful accounts. We call it an allowance. That says allowance, believe it or not. We call that an allowance. That number that's splodged there is an allowance. We call that an allowance. Okay, allowance for doubtful accounts. And that allowance for doubtful accounts, what we'll do is we'll still report our accounts receivable, but it's not going to be 99,000. It's going to be what? If we only credited the allowance, the what? The accounts receivable is now going to be the full 100,000. Accounts receivable will be the full 100,000. And we'll report that allowance. Didn't we debit it? Credit the allowance? Didn't we just credit the allowance? Credit that for 1,000. So that's going to be like a contra asset, isn't it? The accounts receivable is a debit. The allowance is a credit. Isn't that a contra asset? So my net receivable will be 99,000, won't it? Net receivable will be 99,000 and what? And the balance sheet will still balance, won't it? Does the balance sheet still balance? Okay. So your instincts were right on. That what? Hey, we got to reduce the asset receivable because we're not going to collect it, and we're going to reduce our income for the period for those amounts that we're not going to lose so that we match it against the sale. The thing that generated that bad debt expense was the sale, wasn't it? And so for the proper matching, we have to take the bad debt expense in the period in which we make the sale. So your instincts were all right on. You just didn't know the account names, which I just told you. You debit the bad debt expense and you do what? Credit the allowance for the amount you think you're not going to collect.
So now, this is probably going way too
go back and adjust those accounts? Or
No.
if you get more bad debt, you adjust just those two accounts?
Will I ever collect everything?
You could. Let's say you only had the one sale and you collected everything. So then yes.
And then what? And then I went to cash sales after that?
I mean, just
Okay.
for the period of time.
Okay, for that period, am I going to collect all this in this period? Am I going to make sales at December 31st?
Well, let's say you didn't collect. Let's say your bad debt was more than the 1%. Let's say it was 7% now. So
you're telling me that I had.
You would have to add that to that. I'm asking, would that 7% or the extra, would that stay in that one contra account, or would you have a whole other contra account?
So you're telling me that I set up, and don't worry, your questions are right on. Okay, I'm not trying to, say, are you kidding me? I don't mean it that way. Okay, so you're kind of sounded like it, but that's not how I meant it. So you're saying to me that what? I debited the accounts receivable for $100,000. I credited my sales for $100,000, right? And at the same time, I debited the bad debt expense for what? For $1,000, and I credited the allowance, right? For $1,000. Okay, good. And then you're telling me that I had that allowance there, but everybody paid me what? Except a couple of people? I mean, what are you saying?
Let's say one person didn't pay you.
One person didn't pay me? How much did they not pay me?
They didn't pay the whole thing, so you're short 10,000.
They didn't pay me 10,000?
Well, you had 10 and 10, so they're saying one of the 10 didn't pay you.
One of the 10 didn't pay me? Did they cry when they said they couldn't pay me?
No.
Huh? They wept openly?
They didn't return our calls.
They didn't return our calls, okay, and we finally decided we're not going to collect on this? Okay, and so what happens? If that's the case, I got to write off the account receivable, don't I? Because now I know one of those people ain't paying me, right? Okay, so now I would be correct to credit the accounts receivable for $10,000, wouldn't I? Because now I know that person's not going to pay me, right? Hang on a minute. I'm going to go ahead and I'm going to credit the accounts receivable for $10,000, right? Okay, and I'm going to do what? I'm going to debit the allowance account for $10,000, right? Because that person can't pay me. So when I debited the allowance account for $10,000, the balance in here is now what? $9,000 debit balance, isn't it? If it's a debit balance of $9,000, now my accounts receivable is going to show what? $90,000, assuming I hadn't collected on anything else, plus $9,000. So now my receivable is showing $99,000. Meanwhile, you just told me that I'm only going to collect $90,000 of that, right? Didn't you just tell me that? That we're only going to collect $90,000 of that? Okay, so we've got a problem because we're not going to collect $99,000. We're only going to collect $9,000, aren't we? So what we should do then is we didn't put enough in here. Apparently, we thought that we were going to only not collect 1,000, but it's actually 10,000 we're not going to collect, right? And so what we should do is we should go ahead and debit bad debt expense now for what? For another, want to debit it for another 9,000? And credit the allowance for 9,000, right? Because apparently we weren't right. We thought at the beginning of the year it was only 1% we're not going to collect. It's actually 10% we weren't going to collect. We should have put 10,000 at least in the allowance, right? And so we go ahead, and when we credit the allowance for 9,000, now how much do we have in the allowance? 10,000. Huh? Am I missing something? What do we do here? We debited for 10 when we wrote it off. We had 1,000 in there, right? And the balance was 9,000. That's not a debit. That's the balance. It was 9,000. Now we just credited it for 9,000. What's the balance now? 0 is the balance here now, isn't it? And so if 0 is the balance, then if I prepare my balance sheet now, I'm showing what? 0 as the allowance, and I'm showing my net account receivable at 90,000, right? How much am I going to collect? 90,000. Really? Am I really going to collect 90,000? Because maybe the same bad economic downturn that affected this guy is going to affect another one of them 10,000s, right? So now I'm sitting there and I'm saying, my uncollectability rate is not 1%. It's not even 10%. I think it's actually, you want to make it 30%? You got it. No, that's fine. You want to make it 30% if I have credit sales of 100,000? And what? I think it's what, 30% of my sales that I'm not going to collect? But what? I've got 90,000 left now, right? And if I'm not going to collect 30% of that, what's that? 27,000? So I need 27,000 in the allowance. I've got 0. So I'll debit bad debt expense again for 27,000 and credit the allowance here to catch myself up for what? For $27,000? And so when I credit that for 27,000, now I'm sitting here with 27,000 in the allowance, right? And so if I subtract off the 27,000, now that receivable is showing net what? 63,000, which is about what I think I'm going to collect left on this. And so if you think about bad debt expense for the year, bad debt expense started out like a trickle, didn't it? Of 1,000. And then what? And then we went ahead and we put 9,000 more in there. And then we went ahead and we put what? 27,000 more in there. I mean, this bad debt expense is really high for the year, isn't it? Because I guess some cataclysm has taken place in our situation. Okay. So what's going on? When we set up the bad debt expense, what do? It's an estimate based on what we think we're not going to collect for the year, right? As people come and tell us they can't collect, we write it off against that allowance. That's why we set that allowance up, right? And if we keep writing down, eventually there's not going to be enough in the allowance, and we may need to do what? Put more in at the end of the year, right? Okay? So that's the whole process now that we've talked about. And so this exchange was really good because that's really where we're going to be going when we reconvene next time, is we're going to be seeing that we will have to estimate how much we're not going to collect at the time of sale, and we will do what? We will set up a bad debt expense for that, won't we? We set up that bad debt expense. We will put the what? Debit to bad debt expense, the credit to the allowance, right? And when we report the allowance, okay, and that's what we're using here, the allowance method, we set up the receivable, what? And we are going to set up the receivable by using an allowance, and we will go ahead and we will put in the accounts receivable, gross, and then we will subtract off what? Subtract off the allowance, just as we did, and this shows up what? Net of our collectability, right? Right? Okay. So what we're going to do next time is we are going to pick up with the in-class example that's going to walk us through a whole set of transactions here where the company has a sale, they put them out in the bad debt expense, etc., right? That is under chapter what? 7. So go to the chapter 7 module. You'll see in-class example. Please bring that, print that next time so you can follow along as we go through chapter 7, right? We'll knock out chapter 7 next time along with the quiz for chapter 7. We're going to knock out chapter 8. 8 first, and then with some luck, chapter 6. So we're going to go 7, 8, 6. Yes, sir. 7, 8, 6. Huh? Say what? 3, 7, 8, and 6. 7, 8, and 6. Okay? At least that's the game plan. Okay, guys. Oh, yeah. You want to turn in your, what do we call it? Career development project? Is that what this is?
Yeah.
Yeah, you can hand that in. Okay, if you didn't bring it, you can. It's better to print it just because I can keep them all together. Otherwise, I got to sift through all the emails. If you want to bring it next time, you can do that. Okay? I will. I always have fun reading these. Yeah. Okay. Don't forget to bring these, guys. That's fine. Week after is fine. Yeah, as long as you bring it eventually. All right. Good work. Those are good questions because that got us probably substantially further than if we didn't have those questions because I just would have been reading the slides when everybody's tired. So those are good questions. Good job. Okay. Thank you. Okay. See you next time. Yeah. How'd that go?
It's okay. I did talk to Alexandra, I think what her name was.
Yeah. Bye bye.
From what I heard, it seems like it's kind of a long shot to get in for internship. So.
Yeah, it is, but that's not what they should have been saying to you there. I mean, the whole point of that meeting is positive thinking, right? I mean, whether you know. Anyway.
It's like 3 or 4 positions they open.
Okay. Oh, did they say it's a long shot, or you said that?
Well, from the positions they gave us, it seemed,
They said it's a long shot, or you did?
I did.
Oh, okay. Well, don't say that. Okay, we're thinking that you're the one, and you keep thinking that way, and.
Well, also, how mobile is that the CPA? Because I may want to move to either Connecticut or Massachusetts.
The CPA
Yeah.
is very mobile.
Okay. There's like different state requirements, or.
There are different state requirements, and the two that you called out are probably about as stringent as California. It turns out that California